I am really thrilled to introduce Veronica Herrera. She is our Chief Tax Strategist at TaxPlanIQ. She also leads our growth program and teaches a lot of the growth sessions. Veronica is a CPA with over 20 years of experience in public accounting. She is a proud graduate of USC. She began her career at PwC in LA. And in 2019, Veronica made a really powerful transition into tax planning by joining me at Meyer Tax Consulting as our tax manager and really my right hand woman. And since then, she's been an unstoppable force, saving clients millions through personal tax strategies. She's played a vital role in not only the growth and sale of Meyer Tax, but also the growth of TaxPlan IQ and the education that people are really thrilled about having. She's sold countless tax plans, ultimately saved my bacon more than a few times, but, now at TaxPlan IQ, she's brought in, wow, this is great. Just from measuring the last few months, I think she's brought in over 300K in onboarding fees with the users she's worked with the growth plan. And beyond the personal achievements and professional achievements there, I always have to say this one special thing. Veronica is who I call my angel. um, I had a serious family incident occur right when she was interviewing for the position at my firm. My sister had a seizure and fell, ended up having double brain surgery in Florida. I'm in Texas. And I had to go back and forth and travel to help her relearn to walk and talk and become a human being again. And I remember interviewing Veronica from the side of her bed in the hospital and being like, I need so much help. I didn't have any manager to help me with the tax stuff. And she came in and she rocked it. And y'all know how hard it is to find people like that. And she's been rocking it ever since. So, Veronica, thank you for all you do. Over to you.
Thanks, Jackie. You're gonna make me cry. I'm so happy to be here with these. I'm honored to be part of this amazing panel with all these bright individuals, and I'm thankful every day to be part of Jackie's team and Dave's team, and just the TaxPlan IQ team. So, I'm gonna kick off and share my screen. Please let me know if you guys thumbs up if you guys are seeing it, if it looks good. We're good. Thumbs up.
It's a
Great.
little slow, but yeah, now it looks like it's working now.
All right, I'll move this out of the way. Great, I'm seeing thumbs up. So, like I said, I'm really happy to be here with everybody. Jackie introduced me, so there's no need to go through the slide. I did want to add a few items, though. As you guys may all know, they give you a lot of work at the big four firms. I was working, I feel like over 100 hours. I probably was. I remember leaving at 2 in the morning and seeing, like, this is not a life. Or the first time we got to leave after filing deadlines, like daylight, I'm like, oh my gosh, we're not vampires. So I made the transition to industry and then back to public. And before I came to Jackie, I ran a very small traditional compliance firm. And I was happy, it was small. I was able to work on, I love public accounting, on different clients and being able to provide, good service from a compliance perspective. Then I saw Jackie on a webinar and I was like, I want to offer tax planning, right? And I went to the owner and he's like, I don't think so, right? We tend, CPAs, sometimes we tend to be more conservative. And that's when I don't even think Jackie was hiring. I just reached out to her and asked if she was hiring, and it happened to be that she was. So I made the transition, even though I wasn't working 100 hours at the firm. I was still working a lot of hours, as you guys may know, just with the deadlines and just being compliant. We have, the bulk of the work in those deadlines, right? We get a big influx of clients. We want to help everyone, so it's hard for us to turn people away. And when I joined Jackie's team at Meyer Tax, I was like, whoa, we're going to charge them what? What? Okay. All right. But we're saving them taxes, right? We're saving them money. And so it's just like others have mentioned, valuing yourself enough to invest in yourself and then also helping your client. It's a win-win situation. You help yourself and you help them. You're going to have happy clients and more of a work-life balance to be able to dedicate more time to things that you love. All right, so today I am going to go into onboarding and implementation, right? So Daniel went over on how to sell a tax plan, right? So that's a big thing, just selling your first tax plan. And then what? Right? What happens after you sell the tax plan? You do your pitch, you present the tax plan, you give them an overview of what you are going to save them, and they're like, all right, let's do it. You get money in hand, right? Because nothing works, you start no work before you get any money, right? They pay you. Now what, right? Onboarding is very, very important, right? Because it could be a very profitable, but it also can be not, it could go bad pretty quickly without the right processes in place, right? It can go off track and it leads to unprofitability on your end, just spinning your wheels, and it leads to unhappy clients. This is where having a structured approach ensures that you not only maximize the tax savings, but you also avoid costly mistakes and inefficiencies, right? So getting the right process is very, very important. All right. So to kick off is the onboarding, right? We're going to go into onboarding guidelines. Consider this part of the client relationship. This is, let's say you have a new client to yourself, or even an existing client that you turn from compliance to tax planning. This is the dating phase of the tax planning relationship, right? It's where, yes, you got to do your first impression when you're selling the plan, but now you're in the dating phase, right? It's a time to continue building the trust, set expectations. So important. Client expectations, boundaries, right? And laid out the foundation for like a successful long-term partnership between you and your clients. Like during our kickoff or selling plan, and reiterate it during your kickoff meeting, like you're in it as a partnership with the client, right? You're in it to work with them to be able to materialize the tax savings that you said that are going to leave a lasting legacy for their family, or utilize those funds for whatever they may want, and just continue leaving a legacy. All right, so kick off with a simple email. So I'm going to go very, very detailed, right? It's usually I go broad overview, but for this particular session, I'm going to go very, very detailed, and you'll get, if you're you purchase the slides, you'll get a copy of all of this detailed email and checklist and the other resources that I'm going to go over. So this is just a sample of the email that we would send when we got our, when we decided, or when the client paid us and became our tax planning client, just reiterating that you are committed to the successful relationship and, invested in getting them their tax strategies, right? I know particularly as CPAs, we can't guarantee the savings. And that might be a question that the client may have, like, are the savings guaranteed? And I know we were asked that a few times during our sales pitch, and we, like, as CPAs, we can't guarantee, but we could guarantee your satisfaction, right? And if, the satisfaction's that, though, you'll make it right. So this email just kicks off and reiterates that. It confirms that you are in it to make sure that they're materializing those tax savings. And then also it opens up the door to feedback, make them feel comfortable that they are, just providing feedback throughout the relationship. And in our case, we had project managers that were assigned to the different clients. I know for a lot of you guys that are just starting, it may just be you, but like I mentioned, with the right processes, it's going to go smoothly, and you'll be able to make a lot of profit on it. So you don't have to necessarily include the project manager, but just say that they'll have access, to, I wouldn't say maybe 24/7 access, but as a virtual firm, you definitely have, it's not like a brick and mortar that closes at 9 to 5, but you do have to set up expectations. All right. So after the email, you schedule a tax plan kickoff meeting. This is very, very important. This was the opportunity. So how it worked in our firm, or Jackie's firm, either Jackie or I sold a tax plan, and then once we sold it, we, like I mentioned, we assigned a project manager. So this was the opportunity to introduce that project manager, right? And introduce them as their main point of contact. But it also is the opportunity to just review the details of the tax plan. Because if you remember, when you sold the tax plan, you didn't give them the details, right? You didn't tell them exactly what strategies you were implementing for them. In TaxPlanIQ, we do have a report, which I'll go into detail, that I would recommend you, actually, Dave presented that earlier, right? It's a report that gives a client a broad overview of the strategies, and it tells them the tax savings associated with it, the risk, what they were expected to do relating that strategy. So I would recommend giving that to them before the kickoff meeting, right? And then also client to-dos. We call them client to-dos in the system. What are they assigned to do? The initial onboarding process is truly a partnership because you will require more communication and more information and more work for them to put on in their part, as you know, as you're implementing, because especially if they're new clients, you don't have all the information needed, right? As far as entity formation and access to their accounting and things like that. So client to-dos are what are they expected to do? What task will they be assigned? And then also, even if you reviewed the services and you included, as I recommend, their services or their, we sold packages, what their packages included in the engagement letter, review it again. Open it up for them to say, if there's any questions on the services. And it helps a lot with the out of scope creep, right? Which couldn't happen very often, right? Sometimes clients are like, well, I paid you this much. Does this not include the kitchen sink and all the other items, right? So you have to be very, very specific with what services they engaged you for. And then also provide an implementation timeline. So this is a sample agenda, very detailed. All right. Communication guidelines, very, very, very important. So we utilized the priority prefix. We use them in our email, and we expected the client and trained them on how to use the priority prefixes, right? So emergency, they require a response within 24 business hours, as soon as possible. Urgent, 48 hours timeline turnaround, and non-urgent, meaning maybe in 3 business days, or it's maybe it's just for informational purposes. It doesn't require a response. And then we would also communicate to the client that we did not check email all day long, right? We only checked email and voicemail twice per day we like to say around 10 a.m. to 2 p.m. and then respond according to priority. Super, super important. I know we've all been there, where the client thinks everything's an emergency, everything is urgent. So training and educating the client is a very, very important thing in the relationship, to make sure that you're setting boundaries, and then they know what to expect from you. All right. So this is a tax plan report that Dave highlighted earlier in the past session, right? This is a report that is generated in TaxPlanIQ, where it's a tax savings analysis. This is what it looks like once you print it. It'll have their name, the company's name, and then a brief introduction, a list of strategies, and then it'll go into detail, a broad overview of the strategies. So in the software, like Dave went over, the first tab of every strategy is client or broad overview, client overview, right? That's what the client's going to see. I know some of our users, like Daniel, they like to modify the report. You can do that in TaxPlanIQ, but I say all this. So this is, when somebody pays a tax plan fee or an onboarding fee, this is a professional way to deliver, like a professional deliverable, right? Like, hey, they have something tangible and material, like this is part of the process of paying that tax plan professional fee. They're paying for professionals, right? And then it gives them detail on what the strategies are. I know there's, some people may just sell the tax plans, others sell what we call maintenance and advisory. And then others sell the implementation, which, like I mentioned, the implementation with these resources and the processes is the most profitable piece of the tax plan. All right. So this is a sample of the items that we would collect for our clients prior to the kickoff meeting that I mentioned earlier, right? Very important entity formation documents. I know choice of entity is, even though you're reviewing the tax returns, you just want to get the additional entity formation documents. Year-to-date financial statements, very, very important. You might have collected as part of the tax plan process before you presented the tax plan, but if you didn't, this is another thing, or maybe the ones that they provided you were not up to date. Year-to-date financial statements, up to date. That leads you like that, opens the door like, okay, maybe there's other things you can implement, or what is their profitability? Are they actually going to save them taxes at a higher tax rate because their activity is going up? Access to their accounting system. So I would ask for both year-to-date financials and then access to their accounting system and or payroll system, particularly, and we'll go over into some of the strategies, right? Like into detail as to what you're going to do for them in the payroll system. But this is very, very important. Even though you're not committed to doing their bookkeeping, right? You just communicate to them like you just need access, like review access to look at the financials. Some clients may say, I do my own bookkeeping. And as we all know, sometimes it's better if they didn't. So this just gives you an opportunity to review the financials, make sure that they're reasonable, and maybe an opportunity if you did want to do their bookkeeping that, you could present there. Year-to-date pay stubs, if they have a W-2 from outside of their, the business that they may be running, maybe the husband or the spouse works and then the other spouse has that business. That is a big thing that we need to review, right? What are they currently withholding on? Just the year-to-date pay stub helps a lot as part of the tax plan. And then really, really important, proof of estimated tax payments made year-to-date. And I mentioned copies of 1041 returns filed for last year's because when you did the tax plan, you should have already received copies of the 1040 and any pass-through, right? Or any business return. So maybe they have additional entities that they did not provide to you. One of them particularly being the 1041. So this is an example of an implementation timeline. So it should unfold into 3 buckets: the 0 to 30 days, 31 to 60, and 60 days and beyond. Now, if you are getting a client right now, it's already the end of October, more than likely you're going to have to move some of these items into the other buckets, right? There are strategies that you can implement after the year end, but we want to move quicker into, the strategies or action items into one or perhaps the 0 to 30 days or 31 to 60. But this will give them, think of like, okay, I'm going to implement, and this is what you should expect the first 30 days, 31 to 60 days, and then 60 days and beyond, right? So one tax strategy that could be put in the 0 to 30 days is definitely the entity analysis. Just let's get anything done relating to that strategy. Let's get that strategy implemented in the first 0 to 30 days. And then the reasonable compensation analysis. I know often we are talking about like, oh, we can, let's do a reasonable compensation analysis. Let's see if we can save you some self-employment taxes. So the sooner you get that done, the more, the more taxes or the probability being able to deliver on those tax savings needs to be in the 0 to 30 days, fully implementing that particular strategy. And then really important, setting up meetings with that advanced strategy vendors, like if you're recommending very complex strategies, these alternative investments like we've talked about, just getting those set up, getting the ball rolling with that. And then also if you're offering to meet with their financial advisor, or some of you guys are financial advisors, or their estate attorneys, right? Like, let's get that going. Let's review what they already have in place. 31 to 60 days, go ahead and adjust, like you should have adjusted the compensation by 31 days. Let's just say that, right? Do not let more than 31 days go without adjusting that compensation. And then let's kick off retirement planning, right? If you recommended a 401k or you recommended, even though The cash balance plan with Jennifer can be done much after. It's much better to get that done in these 31 to 60 days, right? And then 60 days and beyond, just refine the strategies. Quarterly check-ins. At a minimum, meet with the client every 30 days when you're first starting with them, and then quarterly check-ins, right? And then prepare for the tax filings and present actual savings versus plan. That was my favorite, like the annual strategy meeting when we got to meet with the client and show them, look what we did for you. This is what we had, planned to do for you, and this is what we actually did. And 9 times out of 10, we ended up saving them a lot more money because there might have been some other lower hanging fruit in strategies that we implemented given their situation. Once we started planning, we're like, oh, we could do this or we could do that for them. Now, if it was something totally different, that's a different conversation. That would be a phase 2 additional tax plan fee, right? But that was my favorite. Like when you see the tax return actually complete and you're able to present to the client, this is what we actually saved you. Okay, so I'm going to go over 4 strategies, very, very simple. I'm going to go into detail on how to implement them. So the first one is reasonable compensation. Step 1, collect information. And this information can be collected, it's automated in TaxPlanIQ that you can collect this information. But this is a detailed checklist of what information you need to collect from the owner or for whoever you're performing the reasonable compensation analysis, right? The date the business started, job title, the percentage. We use a many hats approach, which is the most popular. What percentage of their time is spent on, day-to-day operations? Do they have employees? What is the title and salary of your highest paid employee? Because as you may know, that the IRS will be like, well, you're paying this guy $200,000, but you only want to pay yourself $25,000. That's not going to make sense, right? So there's a reason why we had to ask all these questions. What their current annual salary, you might be able to see that in their, even though they gave you access to the payroll system, I would still just have them completely try to answer this questionnaire. And then what hours do they work? Because that comes into play determining the reasonable compensation. So simple, fairly straightforward strategy. We still need the details, right, to be able to implement it. And then this is what you do. So you collect the information from the client and then you turn around and then, let's just get it implemented. Let's determine the reasonable compensation. So you understand the roles, you gather the financial information, these are the 3 different approaches that you can utilize. Like I mentioned, there is the cost approach, income approach, and then market approach, which is pretty straightforward, right? And most popular. Really, really important when you are thinking of reasonable compensation, factor in the value of non-cash benefits. So if the reasonable compensation is $40,000 and the entity pays $10,000 in health insurance for them, then you only have to distribute an additional $30,000 in W-2. So that's really, really important. And then these are, just implementation, tax continued. As far as maintenance, always stay updated our IRS guidelines and courts, and we roll updates into the system continuously. And document, right? I think we've all heard that, but it's so important, especially in the event of any audits. And I would recommend conducting the reasonable compensation review annually. And so we have in our checklist like recurring items, and this is part of it. So this is an example of what we have in our system, right? Where you or whoever's implementing the strategy will check this off as done. We have recurring checklists and then another tab for eligibility criteria. So basically that checklist that I just showed you guys, all automated in here. All right, another very simple, straightforward strategy is the accountable plan. So just a quick overview, it's not employee benefits and does not have to adhere to non-discrimination rules. There has to be officially set up a plan. It is recommended that when you officially have a Word document, I'll show you guys, or a PDF, just a plan, right, that states the terms of the accountable plan. And then collect there's a really cool template we use, and I'll share that with you guys to collect the information from the client. And then reporting the tax deduction, right? So very simple, straightforward, but again, there still needs to be a checklist and documentation. So SNC, the accountable plan is for SNC Corps, and then partnerships and sole proprietors, the equivalent would be like a home office and just reimbursement, right? So that's it gets you the same tax deduction, just a little different. So there's a create a formal written document, right, that outlines the accountable plan, document the detail, the IRS requirements for the plans, collect the reimbursed expenses. Some people collect it on a quarterly, we would collect it yearly, and then report the deductions on the business returns. You also need to record in here, very important, like what happens with amounts that, need to be reimbursed. There's standard language that is in that template. So this is a detailed example. Like if you got the slides, you'll be able to see one for one every single word of this example of the accountable plan and expense reimbursement, right? And then this is the Excel checklist. This is just a sample we would give them. And then the accountable plan weekly, yearly. And then again, the accountable plan can be used for owners. It's favorable more to owners. If they did want to offer it to the employees, that the employee would also have to sign off on this. Okay, the next one is Augusta rule. Really cool, right? We could rent the home. It has to be their main home, up to 14 tax. Well, actually, I'll take that back. But it has to be a home they own. Rented up to 14 tax days, 14 days tax free. The rent must be reasonable, and the business use has to be documented. And it applies to any taxpayer who owns a home in the US. So that's very, very important. And another important thing, it can be used in, if you're already taking a home office deduction, you can still claim it, but you can't double dip. It has to be a different area of the home. So if you're utilizing, there's a dedicated space for the home office, and then you invite some people over for dinner, you're using the dining room, right? Or you have a barbecue, you're using the backyard. So it can be used for that. So this is implementation tasks that have to occur for you to fully implement the strategy, right? You evaluate the client owns a home, you do determine eligibility, you select a reasonable rate. So this is where this is a client to do, a client task. I usually ask them and assign them through TaxPlanIQ, hey, you need to provide me with business use of a home. How many people attended? And what is the fair market value of the rent, right? So I have them call their local area. If it's a group of, I'm claiming that we had a meeting with 5 people. Okay, what would it cost to rent a meeting room for a day or 4 hours, right? And that's the amount that we would deduct as the expense under the Augusta rule. Or if they wanted to have an event with 20 people, what would it cost to rent an event room, in your area for 20 people? And that's how the rent deduction is determined. Execute a rental agreement. So TaxPlanIQ, we have an example of a rental agreement. You review and compliance, right? Regularly review the compliance rules around Augusta rule, maintain detailed records. Since the incomes from renting the home for up to 14 days is tax-free, don't report it as rental income on the client's return, okay? But just keep the documentation and records in case of an audit. And we have, like I mentioned, all these items in TaxPlanIQ. All right, the other strategy, the basic low-hanging fruit, hiring kids. We have to build audit-proof support, right? And I split it into 3: client to-dos, the task, setup checklist, and a recurring checklist. So it's a beautiful strategy, but everything, it has to be set up correctly. So the client, it's really important that if the kids don't already have the bank account, open the bank account, right? What do they want to pay their kids? And it has to be reasonable. This is where it has to be explained, it has to be reasonable, and it depends on the client as well, right? Are they very conservative or are they very aggressive? I always go with the standard deduction. Some clients may not want to do the standard deduction. It just depends on, like I mentioned, the risk, if they're risk averse or not. Provide duties and expected hours to be worked by children. So it's really, really important that this is documented as you go. And then we always recommend coupling like paying the kids with a Roth IRA, since there is earned income. And that's one strategy that we claim on there. It's not a tax deduction, but it does grow tax free. So we have an ability to show that in the tax plan to the client, like what the savings are with that. Let's see. Okay, on your end, right? I rather add the children to payroll myself, because you can tell the client how to add them, but I rather make sure that it gets done correctly. Just, and if they don't already have payroll, that's fine. You don't need to go pay for a payroll subscription if they're a sole proprietor, since there's not gonna, and the kids are not subject to Medicare and Social Security or anything else. Just make sure that the children are paid via check or direct deposit at a minimum monthly, right? Like, let it be a clear audit trail from the business account to the child's account. And if they're added to the payroll schedule, make sure that we're claiming the right exemptions, right? Like when you're adding them to the system, whatever payroll system they may utilize. Really, really, really important. For you to continue filing, if they weren't already filing, like I mentioned, a sole proprietor that wasn't paying themselves, make sure that you file 941s, even though it's just one number for the paying the kids and no taxes involved. You still need to file the 941, 940s, and still issue W-2s. The only thing that's going to be populated in the W-2 is box 1, right? For these kids, nothing was assessed. Also, really, really important though, depends on what state you live, because it depends on the state what filing thresholds they have. We did have a client in Georgia that, even though they were under the federal state, they needed to file a state return, which triggered a minimal fee for the state taxes. Remind clients to keep timesheets and proof of reasonable pay. So that's really important. And then review value of strategy annually and take into consideration filing requirements, like I mentioned, due to state and unearned income. So this is where, selling the tax plan, implementing, and then also maintaining the tax plan is very important, because as their lives changes or as their income changes, things tend to change, right? So that's really important, just to keep reviewing the strategies. Okay, so we went over 4 very basic strategies. This is the annual tax plan in review, right? So this is that annual meeting that I mentioned that I like so much. We schedule the annual tax plan review with the client. We wouldn't wait, not for all our clients, we wouldn't wait till the tax return was filed, because a lot of our clients had K-1s. So we wouldn't file the tax return till September or October the next year, right? Because they were waiting on those K-1s. But the tax returns had to be 99% completed by April to reassess quarterly estimates. All our clients, well, actually 99% of our clients received quarterly estimates. So it was really important for it to be, done through 90% done by April. So we started scheduling annual tax plan review meetings in May, right? May, June, July were the tax plan review meetings, where we reviewed what the actual versus plan savings were, utilizing a report in TaxPlanIQ. We would get updates from the client on what goals or they had as far as personal or business, or what was going on with their business and personally. And then we utilized it too as an opportunity to try to identify additional strategies so they could continue seeing the value in our services, right? And we utilized this opportunity as well to increase our fees. This was a perfect, when they're good and happy and they see the large return on investment, we tell them, hey, we're also going up on our fees, right? Whether they implement the phase 2 or not, that's just standard. Okay, I feel like I went really, really fast, but we covered 4 fundamental strategies that apply to 90% of the clients. Low-hanging fruit, for those that are just starting, this is a perfect example. I would recommend, choosing, like Daniel mentioned, going down your list, choosing people that are easy to implement, get practice on that, and then moving up to more advanced strategies, right? And gave you guys actionable steps into implementing and onboarding. So that's just 4, but we have over 120 strategies in Tax Plan IQ, and like you don't have to be a tax planning expert, like Michelle said. That the system automates, and with the right processes and checklists, you can continue, adding the value and not spending tons of hours learning the law yourself. So in Tax Plan IQ, every strategy is supported by resources and task and client communications. So thank you.
Awesome.
Mhm.
Awesome. So we do have some questions. And since we have a little extra time, I'll just go ahead and dive in if you don't mind.
Sure.
Get them.
Do you have them actually pay the rent amount or just deduct it?
I like to have them reimburse it.
Yeah, you want that cash paper trail. So,
Mm-hmm.
all right, that was easy enough. Do you recommend setting up a family management company to pay the kids? Why or why not?
Well, what structure, like a C corp? Is that
They
what we're
don't really
talking about?
say. I mean, a lot of people do a Schedule C environment for that, and it does seem to be pretty successful. Um, there's, a pretty well-known thought leader out there that highly recommends that. And so when I start seeing thought leaders recommend it to thousands of accountants and whatnot, I tend to kind of get over my fears of it being too aggressive.
Yeah, and I think you and I saw last time too, even in Texas, Texas workforce recommended the Schedule C. So when they
Yeah,
recommend
they
it,
sure did. That was crazy. Yeah. So yeah, awesome. And then at what amount of gross income should I start these types of planning strategies?
these can be started even if they're taking home or they're taxing at 150,000, or 200,000. Yeah, this is a very low hanging fruit that can be easily implemented and save them. You could sell a tax plan for $5,000, right? Yeah,
Mhm.
this is fairly easy and standard.
Yeah, for sure. I mean, I was popping in the chat. I felt really bad for my hair person because she literally could have wiped out. I mean, she's not high income, obviously, but we just talk while she's doing my hair and she starts asking me tax questions. And of course, I'm trying to help her out. And she could have wiped out her entire self employed tax liability on her Schedule C for the last 3 years just by hiring her kids. And her accountant never told her that, right? And her kids were actually already doing work for her. So, I just gave her some guidance as to how to do it, obviously, and we have some bartering going on, but that's a side note. Blonde hair is expensive, y'all. Okay. But yeah, I mean, any income level, it's just about what minimum price point is acceptable to you to take for the work. And then you have to back into, well, okay, what does that look like for a savings perspective for the client? Because if you want to bring a return on investment to the table, and let's say you found $10,000 of savings for the client, um, that's not that high of income if that's all of their taxes. But if your minimum is $5,000 or $7,000 a year, that's not a huge margin to really help the client out, right? And so as long as you can bring that margin to the table to where you're both profiting really well off of it, then you're in good shape.
Yeah, I would
Uh,
say the $5,000 tax plan is a sweet spot because it is gonna, with the right processes, you could streamline it, but it could go bad, like make sure that you're being compensated for the time at least, right?
Yeah,
And
for sure. And I guess to clarify that even further, to find 10,000 of savings and it's probably recurring year to year and charge 5 grand, there's actually really nothing wrong with that. I mean, you've got an ROI that's going to go out for many, many years to come, right? But we'll circle back to the ROI stuff when we talk about pricing at 335, and I've got some pretty mind-blowing stuff to show you then.